Hi everyone! Over the past 10 years, the S&P 500 has more than tripled. But do you know which industry drove most of that growth? Surprisingly, it was the information technology sector. In fact, tech stocks have gone up more than 6 times. They're the only sector that beat the S&P 500. All other sectors underperformed. In other words, the rise of the S&P 500 was almost entirely driven by technology. That's why I've created this series to help you understand the most powerful and long-term worthy tech ETFs. Today we'll focus on one of the most iconic tech ETFs in the market. It's called the Technology Select Sector SPDR Fund. Ticker symbol XLK. We'll cover its long-term returns, the risks, and how it compares with other tech ETFs. Let's start with the basics. XLK was launched on December 16, 1998. That's over 25 years ago. One of the oldest tech ETFs around. It's managed by State Street Global Advisors. This company is one of the largest asset managers in the world, and they also launched the very first ETF ever. XLK charges a very low fee, only 0.08%. It's extremely cost-efficient for long-term investors. In terms of size, XLK is huge. It currently manages over $83 billion. Over the past 10 years, XLK has gone up 6 times. In comparison, the S&P 500 only tripled. But what if we go back further? If you invested $10,000 in XLK at the start of 1999, you'd now have over $107,000. That's a 10-fold increase. The same amount invested in the S&P 500 would only be worth $81,000. So over 26 years, XLK delivered an average return of 9.35% per year, compared to 8.23% for the S&P 500. The best year? 1999, a massive 65% gain, much higher than the S&P's best year. But let's not forget the risks. XLK experienced a major crash during the dot-com bubble. In the year 2000, it dropped over 41% in just 1 year. The total drawdown reached 80%, and it took over 14 years to fully recover. From 1999 to today, XLK had 191 profitable months. That's nearly 60% of the time, a bit less than the S&P 500's 200 positive months. If you had invested at the peak of the bubble, holding for 3 years could still mean a 38% loss. Even over 5 years, the worst-case loss was 19%. So XLK is not a set-it-and-forget-it type of investment. You still need to watch valuations and avoid investing too much during market hype. Now let's break down the strategy behind XLK. It's actually very straightforward. Step 1. Only choose stocks from the S&P 500. Step 2. Only include companies classified as information technology, based on the official GIC's industry classification. That's it. The ETF uses adjusted market cap weighting, which means bigger companies have more weight, but with some limits to avoid concentration. XLK is rebalanced quarterly. Right now, it includes 67 stocks. Most of the exposure is in software and semiconductors. Here's the breakdown. Software, 37%. Semiconductors, 36%. Hardware and storage, about 13%. The rest includes IT services, equipment, and electronics. And now the top holdings: NVIDIA, 16%. Microsoft, 14.6%. Apple, 11%. These 3 giants make up over 40% of the entire ETF. Then you've got Broadcom, Oracle, and Palantir in smaller proportions. So, if you're looking to invest in the future of technology and want exposure to both semiconductors and software, then XLK could be a strong candidate. Its key advantages: focused exposure to the US tech industry, balanced across AI infrastructure and applications, holds only large-cap S&P 500 companies, very low management fee, and a long track record. Of course, the risks are real. Tech can be volatile, especially in bubbles. That's why it's smart to use dollar-cost averaging. And during pullbacks, like in this April, consider adding more carefully. But the big question is, do you believe tech will continue to lead the next 10 years? Leave your thoughts in the comments. And don't forget to like and follow for more investing ideas. Let's keep searching for investments that are buy once, hold forever. Thanks for watching.